now we'll shift our gears and focus on gold. Gold prices have seen quite a correction in the year 2021. In fact, since even November and December, after touching that record high level of 57,000 per 10 grams, gold has now slipped by 10,000 rupees per 10 grams. In fact, the last time I checked on the MCX, a gram of gold demanded around 4400 rupees. So interestingly, this drop in gold has also brought about a flurry of those individuals who want to buy jewelry. So physical demand for gold, maybe in the form of jewelry or in the form of bars, etc., has increased. But the question is, what about when you want to consider gold as a part of your investment portfolio? So we'll tackle that bit of the topic. And the second thing I want to talk about is dedicated for those individuals who've invested in tranche 3 of the sovereign gold bond scheme, which was issued in 2016, and now it is up for early redemption. Remember, SGBs have a maturity of 8 years, but after 5 years, you are eligible for an early redemption. So we'll talk a little bit about this topic with Uday Dhoot, co-founder of Venn Wealth. Uday, it's a pleasure having you back with us on the Money Show. Thanks so much for taking out time. So Uday, crack in gold prices, and right now everyone's wondering that what happened. I mean, it was at 56,000 and now it's dropped by 12,000 rupees in just the last 6 months. And this is an asset we consider to be not so volatile.
See, Mobina, last 1 year has been exceptional in terms of asset price movements, right? You can take any asset class. The daily volatilities across asset classes have been extremely high. And we have seen things moving very quickly and falling very quickly. So I think given the kind of environment we are in, we should expect this to happen in pretty much all asset classes. You look at what happened suddenly, and the thing with gold is that obviously it peaked around the time wherein this whole COVID-related issues were at their peak. People didn't know what the future held. And across the board, interest rates were, at least in developed markets, going to 0 or below. And so to that extent, people did what they usually do, is that at times of stress and where nothing else is available, you move towards gold. Now, equity markets have moved up handsomely over the last 6, 7, 8 months. We have seen that starting January, interest rates have moved up quite a bit across government papers, across the globe. So all of that has taken some sheen off gold for sure. But for our investors, I think the important piece is to obviously think about the asset from an overall asset allocation standpoint of view. Yes, the movements in prices do impact how you think about it. But I think the thought process should not just be on what has happened and the prices corrected, but more an asset allocation driven approach is what is required to maintain that discipline to make the most of it. You take equity, for example. I think last year, the beginning of the year, we were doing well, and then you corrected. But if you took the asset allocation approach and you rebalance your portfolio in, say, April, May, June, you would be sitting on handsome returns. So I would say that yes, prices have corrected, but use your asset allocation approach. Use that to either overweight your position, underweight your position, or rebalance your portfolio in gold.
All right. So now perhaps maybe a good time to rebalance one's portfolio. Now, those individuals who may have got into the whole frenzy of, the gold rush, as we called it back in July and August, and looking at, the way gold prices were moving, may have purchased gold as well at those high levels of, 55, etc. They may be a little disappointed, obviously. But Uday, that's where I want to understand your view. How do you look at gold as an investment? Is it a hedge? Is it, somewhere you just park your money because there's nowhere else to park? Or do you, should there be expectations that this is an asset that will give me good returns?
See, if you look at really long-term returns from gold, it has kind of given somewhere close to inflation beating returns in India. And the big reason for that is that INR has continued to depreciate against USD, which is how the global pricing or trading of gold happens. And to that extent, I think it's a natural hedge against inflation for Indian investors. Now, the theory around holding of gold at around 5 to 15% of the portfolio has been this whole thing around debasement of currencies. As money has been printed, we are seeing almost from the global financial crisis, there was a fair amount of money printing that happened, and people were saying that, hey, inflation will come back and this will happen. Nothing happened. No inflation came back. And then last year with pandemic, suddenly the amount of money printing went through the roof. And this has led many believers across the globe, or at least thinkers who have seen such past scenarios of huge amounts of money printing, is saying that, hey, this finally ends up leading to debasement of currencies. And the only way to protect yourself against those debasement of currencies is to hold on to real assets, which comes in form of either physical gold or gold in some form, or real estate, etc. So if you look at it, it can serve multiple purposes depending on where you are and how you see it as a part of your portfolio. Holding around 5 to 10% in your portfolio at this moment would kind of make sense. For people who got into gold, say somewhere around last year at the highs, and if you've done this through ETFs and through say gold fund of funds, and not the SGB route, but let's say if you've done this through the ETF route, FOF route, and so on and so forth, maybe before March 31st, you could actually sell some of those gold and buy it back and book this temporary loss and basically set that off against your other gains. So that way, because if you have used like a portfolio approach, you would have gains in other parts of your portfolio, and you could use some of these short-term losses at least to postpone some tax payment that you can do. So some good will come out of it, but definitely reallocate the money to gold.
All right. Okay. So, I mean, that's essentially how you should be viewing gold in your portfolio as an asset class. Uday, your favorite way of investing in gold then, now that we have more than one, it's not just, that, okay, I want to invest in gold, so I'll buy coins and bricks. There are several digital options as well.
So our preference, basically we try to spread the gold between the ETF and the SGB route. The reason is that the SGP is a fairly illiquid option, but obviously the best option for long-term holders of gold, because you get that additional 2.5% interest from the government, plus on maturity the capital gains is tax-free. So if somebody was to buy gold for an 8-year horizon, then definitely SGBs are the best. But sometimes in situations like this, wherein you want to do some amount of rebalancing, you want to exit, you want to enter, you want to make some short-term trades, then your gold ETF, or for people who do not necessarily have an active trading account, then maybe doing like a gold fund of fund would be easier, simpler options to do this. For a lot of retail investors, I think the FOF route, which is the fund of fund, basically a fund which invests in gold ETFs, might be a very good, simple route to hold on to gold as such, because it allows you to do like as little as 500 rupees a month. Of late, there has been an extremely high amount of popularity of holding this e-gold through some of these digital gold sellers. I think from a that also is a fantastically great way of holding gold. But what happens for us from a portfolio standpoint of view, it becomes easy when all of this is under either mutual funds or ETF. You can view it in one single place. Sometimes, like I was just suggesting, saying that, hey, if your gold is sitting at loss, you could do some amount of tax loss harvesting using that. So all that becomes slightly more convenient if it is in ETF and FOF route. But definitely SGB is something for long-term investors. So I would say that split it between some SGBs and some FOF ETF kind of holdings.
Okay, all right. Uday, let's talk about sovereign gold bonds then. If you had invested in them, if you were an early bird investor in 2016, that's specifically tranche 3 of the SGB, which is actually due for a redemption in March 2024. In March 2021, you are eligible for early redemption. So before holders of that tranche of sovereign gold bond schemes do go in for redemption, what are the points they should consider? Who are the ones who should go in for it? Who are the ones who should still hold on to it till the end of 3 years, for another 3 years, pardon me?
So, like we talked about entry, it's the similar logic that we should be using from an exit standpoint of view, right? So, you do this because you want to rebalance your portfolio. So, somebody who's entered in 2016 obviously is sitting on some handsome returns here. So, he now needs to see that, hey, where is the allocation to gold? How much does he now want to exit out and then take a call? Importantly, that he needs to remember a few things, he or she who is investing in these SGBs, is that when you do a premature exit from an SGB, which is basically after completing 5 years, the capital gains are taxed as long-term capital gains tax. You don't get tax benefit of exemption. Tax benefit of exemption is available only on maturity of the SGBs and not on premature exit from the SGB. So one, that is a point that you need to keep in mind, remember. And let's say if you are holding gold in multiple assets, in say ETF and in SGB, then I would say that, hey, maybe if at all you want to cut down your position, you cut down the ETF first and let the SGB run. So that way what happens is that chances of you basically overall reducing your taxes is there, because you could hold the SGB until maturity and do your exit through the ETF or the FOF route. So that way you can balance your portfolio as well. So keep these things in mind while you are looking at exit. Importantly, from an operational standpoint of view, if you still want a premature exit from your SGB, you have to remember that at least a month before the next interest payment date, you need to reach out to your service provider and ask them for an exit. Ensure that your bank accounts are correctly updated if you're holding these SGBs in demat form, so that the money from the principal money comes straight to the bank account and to the right bank account.
Great. Well, Uday, thanks so much for joining us and, just sharing with us, a comprehensive view on gold, investing in it, and also, of course, exiting it as well. And on that note, we are out of time as well. So, ladies and gentlemen, thanks for watching.